How does corporate bond yield to maturity work? Imagine you're thinking about buying a corporate bond and want to know what kind of return you can expect if you hold it until it matures. That's where the concept of yield to maturity comes into play. Yield to maturity is the annualized return you would get if you buy the bond at its current price, keep it until it matures, and all payments are made as scheduled. It's a way to see the real earning potential of a bond, considering both the interest payments and the final repayment of the principal amount. Think of it as the bond's internal rate of return, or IRR, for its cash flows. This includes the regular interest payments, called coupons, and the amount you get back at the end, which is the face value of the bond. Yield to maturity is expressed as a percentage, making it easy to compare different bonds regardless of their prices or terms. If a bond is trading below its face value, the yield to maturity will be higher than the coupon rate because you're buying it at a discount. Conversely, if it's trading above face value, the yield will be lower. The relationship between bond prices and yields is inverse. When market interest rates go up, bond prices tend to fall, which pushes the yield to maturity higher for new buyers. When rates drop, bond prices rise and the yield to maturity decreases. This movement helps investors understand how changes in interest rates can affect their returns. For passive income seekers, knowing the yield to maturity helps decide if a bond's return is worth the risk, especially when considering credit risk and interest rate fluctuations. Yields also make it easier to compare bonds with different maturities and coupon rates. If you're aiming for steady income, you want to find bonds with attractive yields that match your risk tolerance. But keep in mind, yield to maturity assumes you reinvest all coupon payments at the same rate and that the issuer doesn't call the bond early. In reality, interest rates can change, and some bonds have call provisions that allow the issuer to repay early, which can affect your actual returns. In practice, investors use yield to maturity as a guide to estimate what they can expect to earn annually if they buy a bond today and hold it to the end. It helps in building a portfolio of bonds that generate reliable income over time. By focusing on bonds with yields that align with your income goals and risk level, you can create a steady stream of passive income through bond and fixed income investments.